People often ask me, Warren, what keeps you up at night? And usually the honest answer is not much. I've lived through enough market cycles, enough panics, enough so-called end-of-the-world moments to know that fear tends to arrive in a hurry and leave just as quickly. But every once in a while, you see a pattern, a signal, a little flicker in the data that makes you sit back, fold your hands, and say, well, now that's interesting. And today I want to talk about one of those signals, a signal tied to 2026, one that's been quietly flashing for years but is only now starting to attract attention. Now, I don't believe in fear-mongering, never made a dollar off panic, but I do believe in understanding risk. That's why we study the past, that's why we examine patterns, and that's why this conversation matters, because the truth is many people haven't seen the warning signs yet. Some don't want to look, and a few very big institutions, well, I'd bet they'd rather you didn't look at all. So let's take our time here. Let's walk through this carefully, calmly, and with the same approach I've always used. Common sense, historical perspective, and a whole lot of patience. Now, you've heard people talk about market bubbles, tech bubbles, housing bubbles, debt bubbles, but the signal I'm referring to isn't about one bubble, it's about compression, financial compression. When asset prices rise faster than underlying productivity, when debt rises faster than revenue, when risk rises faster than understanding. The first time we saw this pattern clearly was in 1929, and again in a slightly different form in 2008. But today in 2026, well, we see something new, a combination of the two. The leverage of 2008 mixed with the overconfidence of the late 1920s. And if you look closely, you'll see the same warning sign flashing, a disconnect between perceived safety and real risk. Back in 1929, people believed the market couldn't fall. Back in 2008, people believed housing couldn't fall. And now, well, a lot of investors believe that the entire system has built-in airbags. That no matter what happens, the Federal Reserve will cushion the landing, that policymakers will step in, that liquidity will magically appear, because it always has. I've said for decades the market is there to serve you, not instruct you. But lately, people seem to believe the market is there to protect them. That's a dangerous assumption, and historically it's one that doesn't end well. Let me explain the signal in plain English. It's the spread between real economic output and financial expectations. When that spread widens beyond a certain threshold, you get fragility. In 1929, it took people by surprise. In 2008, it took the banks by surprise. And today, I'm not sure anyone's paying attention at all. Now, I'm not saying 2026 is destined to be another 1929. History doesn't repeat, but it does rhyme. And this rhyme, well, it's got a pretty familiar cadence. Here's the difference. In 1929, leverage was high. In 2008, leverage was enormous. But today, depending on how you measure it, global leverage makes both of those periods look modest. You've probably heard numbers like 600 trillion thrown around. People toss those around like they're rounding errors. But numbers that large, well, they deserve respect. They can't be unwound cleanly. They can't be stress-tested neatly. They certainly can't be backstopped easily. And that brings us to the 2026 question. What happens when you combine record debt, inflated expectations, geopolitical tension, AI speculation, and a public that believes markets only go up? Well, you get a system that looks stable until it doesn't. In 1929, the crash erased almost 90% of market value. It took nearly 25 years to recover. In 2008, the system nearly froze. In 2026, the risk isn't freezing, it's fragmentation. Markets that behave like glass, solid until the moment they crack. Ben Graham used to say the market is a voting machine in the short term and a weighing machine in the long term. Well, lately the market hasn't been voting or weighing, it's been assuming. And assumptions, especially in finance, are dangerous things. Every major crisis in modern financial history, every single one has had the same quiet early indicators. Liquidity dries up at the edges first. Volatility looks low until it surges all at once. Large institutions quietly de-risk before the public knows anything is wrong. Retail confidence peaks right before the downturn begins. Something small breaks first, then something big breaks fast. You saw it in the dot-com bust. You saw it in the housing collapse. You saw it in the Asian financial crisis. And now, the same footprints appear again. Nobody wants to talk about this because nobody wants to be the messenger. Being early sounds a lot like being wrong. And being cautious while markets are euphoric, well, that's never popular. But I've never run Berkshire Hathaway based on popularity. I've run it based on probability, and probability tells us something simple. When risk hides behind optimism, risk usually wins. You know, we live in a world that moves faster than any time in human history. People are overloaded with information but starved for wisdom. They stare at screens, not fundamentals. They trade what's popular, not what's profitable. And that's why this 2026 signal is so easily ignored. People don't see fragility because fragility doesn't announce itself. It doesn't wave a red flag. It's quiet. It's polite. It shows up as higher valuations, lower savings, faster trading, thinner margins, and debt schedules stretched just a little too far. In 1929, the public didn't see the leverage building. In 2008, they didn't see the mortgage derivatives piling up. Today, many don't see the layers of interconnected risk, the algorithms, the leveraged funds, the high-frequency trades, the synthetic instruments that move trillions with the tap of a key. The market used to be made of people. Now it's made of speed, and speed is wonderful until you need it to stop. Now let's get practical. What is this hidden 2026 signal? It's the divergence between equity valuations and real economic resilience. We've seen this before, but never at this scale. The economy is growing, yes, but not at the same speed as asset prices. Wages aren't keeping up with costs. Corporate profits aren't keeping up with debt. Productivity isn't keeping up with investment expectations. That gap, that expanding distance, is the signal. In the 1920s, the signal was margin debt. In the 2000s, it was mortgage leverage. In 2026, it's structural overconfidence tied to synthetic stability. To put it simply, people believe the system is safer than it really is. When belief diverges from reality, a correction follows, and the longer the divergence, the sharper the correction. Now, I'm not the only one watching this. If you look carefully, and I mean carefully, you'll notice the big players acting just a little differently. They're trimming around the edges, rotating out of certain sectors, reducing exposure to highly leveraged plays, shortening duration, raising liquidity, increasing hedges, holding more cash than usual. That's not fear, that's preparation. Because here's the truth, big money never panics. It prepares. The public panics. Retail panics. Crowds panic. But institutions, they see shadows long before the crowd sees the storm. I'm not telling you this to scare you. I'm telling you this to empower you. Now, let's talk about what matters. How does the average investor protect themselves from something like this? First, don't panic. You never make good decisions under duress. Second, avoid leverage unless you're absolutely sure you know what you're doing. Third, don't chase fads. If something's rising simply because it's rising, that's not investing, that's adrenaline. Fourth, build cash reserves. Not because cash earns a high return, because cash earns optionality. Fifth, and this is the most important, invest in real value. When the tide goes out, as I've said many times, you get to see who's been swimming naked. And when markets correct, overvalued assets fall the hardest while true value stands firm. Strong companies with real earnings, real cash flow, real products, real customers, they survive every storm. They always have. If the 2026 signal turns into turbulence, those businesses will still be producing value on the other side. And value, real, tangible value, is the best life raft in any market. You know, people forget something important. Markets don't collapse because of one bad day. They collapse because of years of unsustainable assumptions. What we're seeing now, the signal for 2026, isn't about panic, it's about patterns. Patterns that have appeared before, patterns that historically resolve in one of two ways: a controlled deflation of expectations, or an uncontrolled correction. I'll never tell anyone to predict dates, that's a fool's game, but I will tell you to understand behavior. Behavior tells you more about markets than numbers ever will, and human behavior hasn't changed much since 1929. People still get greedy, people still get overconfident, people still assume the future will look like the last 12 months. But the world doesn't move in straight lines, it moves in cycles. And right now the cycle is flashing a quiet warning. A polite warning, the kind of warning the public tends to overlook until the consequences arrive all at once. But remember this, crisis and opportunity are close cousins. If you stay calm, keep perspective, and invest intelligently, you don't just survive downturns, you benefit from them. I've made most of my best investments during times of fear, and if 2026 brings one of those moments, whether it's a small correction or something bigger, well, the people who keep their heads will come out stronger. In the long run, markets reward patience patience, discipline, and rationality. That's as true today as it was in 1929. So pay attention, stay informed, be cautious, not fearful, and always invest with a margin of safety. Because signals, no matter how hidden, are only useful if you act wisely when you see them. Thank you for your time.